Before we begin, please remember that this presentation is for educational and informational purposes only. I am not a financial advisor, mortgage broker, or licensed professional. The information provided in this video should not be considered legal or financial advice. Buying a home and securing a mortgage is a major financial decision, and you should always consult with a qualified and licensed professional to discuss your individual situation before making any decisions. Let me ask you a question. For the exact same $400,000 house, would you rather pay $600,000 for it or $680,000? The answer seems obvious, right? But what if I told you that millions of Americans unknowingly choose the more expensive option every single year? That $80,000 difference, that's the price of a brand new luxury SUV, a down payment on a second property, or even sending your kid to college. And it all comes down to a single number, a number that most people don't truly understand: the mortgage interest rate. Just one single percentage point, the difference between a 6% rate and a 7% rate on that $400,000 loan, is over $81,000 in extra payments over 30 years. $81,000. Poof, gone. Not for a bigger house, not for a better neighborhood, but just for the privilege of borrowing the same amount of money. When you see it like that, it's terrifying. It feels like the single most important number in your adult life, yet it's treated like some dark art, a mysterious figure that a banker in a suit just plucks from thin air. You're told to shop for rates. But what are you even shopping for? You hear terms like APR, points, fixed rate, ARM, MBS, the Fed. It's an alphabet soup of financial jargon designed to make you feel small, confused, and powerless. You end up just taking whatever rate you're given, crossing your fingers, and hoping you didn't just make a 30-year mistake. Well, that ends today. This isn't just another boring finance video. This is your masterclass. This is the guide I wish I had when I bought my first home. Over the next 10 parts, we are going to pull back the curtain on the entire U.S. mortgage industry. We are going to demystify the jargon, expose the myths, and arm you with the knowledge to walk into any lender's office with unshakable confidence. My promise to you is this: by the end of this series, you will understand mortgage interest rates better than 99% of the population. You will stop being a passive rate taker and become an active, educated rate master who can save tens or even hundreds of thousands of dollars. So let's start at the absolute beginning. What even is an interest rate? The simplest way to think about it is this: an interest rate is the rent you pay on money. When you buy a car, you rent the car. When you stay in an apartment, you rent the space. When you take out a massive loan to buy a house, you are renting a huge pile of cash from a bank, and the interest rate is your monthly rental fee for using their money. The principal, the actual loan amount, is what you pay back to return the money you borrowed. The interest is the bank's profit for taking the risk and letting you use it for 30 years. But where does that rental fee, that interest rate, actually come from? This is the core of the mystery. It is not random, and it's the key to understanding why rates go up and down, sometimes week to week, or even day to day. There are three main forces that work together to create the mortgage rate you see advertised on a billboard. Think of it like a three-layer cake. The bottom layer, the foundation of the entire cake, is the global bond market. The second, middle layer is the Federal Reserve. And the top layer, the frosting, is your specific lender. Most people have this backwards. They think the Federal Reserve is the whole cake. They hear on the news, the Fed raised rates, and they assume that means their mortgage rate just went up by the same amount. This is probably the single biggest, most costly misunderstanding in real estate. Let's be crystal clear. The Federal Reserve does not directly set mortgage rates. What the Fed controls is something called the federal funds rate. This is the super short-term interest rate that banks use to lend money to each other overnight. It's the cost of money at the highest, most basic level of the banking system. Think of the Fed as controlling the price of the raw ingredients like flour and sugar for our cake. When the Fed raises its rate, it makes those raw ingredients more expensive for the big banks. This creates a ripple effect. It influences the rates on things like credit cards, car loans, and home equity lines of credit. But it is not a direct one-to-one link to that 30-year fixed mortgage rate you're trying to get. The real driver, the giant bottom layer of our cake, is the bond market. Specifically, a type of investment called mortgage-backed securities, or MBS. Now, don't let the name scare you. The concept is actually pretty simple. When a bank gives you a mortgage, they don't just hold on to it for 30 years. That's way too much cash to have tied up in one place. Instead, they bundle your mortgage together with thousands of other mortgages and sell that bundle to big investors on Wall Street. Think pension funds, investment firms, even foreign governments. This bundle is a mortgage-backed security. The interest rate on your mortgage is directly tied to the price investors are willing to pay for these MBS bonds. It's a game of supply and demand. If investors are feeling confident about the economy and want a safe place to park their money, they'll pay a high price for these bonds. When the bond price goes up, the interest rate or yield on that bond goes down. And because your mortgage is inside that bond, your potential interest rate also goes down. Conversely, if investors are scared of inflation or think the economy is risky, they demand a higher return for buying these bonds. They pay a lower price, which pushes the yield up, and your potential mortgage rate goes up with it. So when you see mortgage rates changing every day, it's not your local banker changing his mind. It's the result of trillions of dollars trading these MBS bonds on a global market, reacting to economic news, inflation reports, and global events. Your 30-year mortgage rate is much more closely related to the yield on the 10-year Treasury bond, another super safe government investment, than it is to anything the Fed says in a press conference. So we have the bond market setting the base, the wholesale price of mortgage money, and we have the Fed influencing the overall cost of money in the background. But what about that third layer? The frosting on the cake? That's your lender, the bank or credit union you're actually talking to. They take that wholesale rate from the bond market and they add their margin on top. This margin covers their business costs, paying their employees, keeping the lights on, and of course their profit. This is why you can go to 3 different lenders on the same day and get 3 slightly different quotes. They are all starting with roughly the same wholesale rate from the MBS market, but they are each adding their own unique markup. And this brings us to the most important question of all. We now understand the massive global forces that create the base rate. But how do they decide on your rate? Why does your friend get quoted a 6.8% while you're offered a 7.3% for the exact same loan amount? That has nothing to do with the bond market or the federal. That part, that's all about you. Think of a lender not as a bank but as a professional poker player. And when you apply for a mortgage, you're sitting down at their table. They don't know you. They don't know your story. All they have is a set of cards you've handed them, and their job is to calculate the odds of you winning, or in their case, the odds of them getting their money back with interest. Every single thing they ask for, every document they require, is another card they can use to calculate that risk. The higher your perceived risk, the higher the interest rate they offer you. That rate isn't a punishment. It's their insurance policy. It's the price you pay for them to take a gamble on you for the next 30 years. So what are the cards they're looking at? The first, and by far the most important, is the ace in the deck, your credit score. This 3-digit number is your entire financial history, distilled into a single grade. It's a report card of your reliability. Have you paid your bills on time every time? Do you carry a lot of credit card debt? Have you ever defaulted on a loan? It's all in there. To a lender, a FICO score of 760 or higher says you're a straight A student. You're dependable, you're responsible, and you're an extremely safe bet. A score between 700 and 759 is like getting a solid B. You're good, but maybe there's a little room for improvement. But when your score starts dipping below 700, and especially below 660, the lender's alarm bells start to go off. Now you're a C or D student in their eyes. Your history shows some late payments, maybe high balances. You look less like a sure thing and more like a gamble. And for them to take that gamble, they need to be compensated. Let's make this real. Imagine a $400,000 loan on a 30-year fixed mortgage. A borrower with an excellent 780 credit score might get offered a rate of 6.75%. A borrower with a decent 680 score, applying on the very same day for the exact same loan, might be offered 7.5%. That doesn't sound like a huge difference, right? It's less than 1%. But let's do the math. The borrower with the excellent credit will have a monthly principal and interest payment of about $2,594. The borrower with the fair credit? Their payment is $2,797. That's an extra $203 every single month. Over the 30-year life of the loan, that borrower with the lower credit score will pay over $73,000 more in interest. $73,000. That's the price of risk, paid for by the borrower. That's why your credit score isn't just a number. It's a direct lever on your financial future. The second card the lender looks at is your down payment. They call this the loan-to-value ratio, or LTV. It's a simple concept. How much of the home's value are they, the lender, on the hook for? If you're buying a $500,000 house and you put down $100,000, which is 20%, your LTV is 80%. The lender sees this and breathes a sigh of relief. Why? Because you have significant skin in the game. You've invested a huge chunk of your own money into this property. If you hit a rough patch financially, you are going to do everything in your power to avoid foreclosure, because you don't want to lose that 100 grand. You're a partner in this investment with them, but what if you only put down 5% or $25,000? Now your LTV is 95%. From the lender's perspective, they are taking on almost all of the risk. If the housing market takes a small dip of just 6%, you're instantly underwater, meaning you owe more on the loan than the house is worth. The temptation to just walk away and mail the keys back to the bank becomes much, much higher. To counteract this massive risk, the lender does two things. First, they'll almost certainly charge you a higher interest rate. Second, they'll require you to pay for private mortgage insurance, or PMI. And let's be crystal clear about PMI. It is not insurance for you. It does not protect you if you lose your job. Private mortgage insurance is an insurance policy that you pay for that protects the lender in case you default on the loan. It's the lender literally forcing you to buy an insurance policy for them against yourself. That's how much they dislike the risk of a low down payment. So, a small down payment is a double whammy. You get a higher interest rate on your loan, and you have an extra PMI payment of a few $100s tacked onto your mortgage every single month. The third crucial card is your debt-to-income ratio, or DTI. If your credit score is your report card and your down payment is your skin in the game, your DTI is your stress test. It's the lender asking a very simple question. Can you actually afford to breathe? Your DTI is calculated by taking all of your monthly debt payments, your car loan, your student loans, your credit card minimums, plus your proposed new mortgage payment, and dividing it by your gross monthly income. Imagine your financial capacity is a bucket. Your income is how much water is in it. Your existing debts have already filled part of that bucket. The lender needs to know if there's enough empty space left for a giant mortgage payment before the whole thing overflows. Lenders generally want to see a DTI of 43% or less. If your total debts, including the new house, would eat up 50% or 60% of your pre-tax income, you are living on the edge. You have very little wiggle room. A single unexpected expense, a major car repair, a surprise medical bill, could be the one thing that pushes you over the edge and makes you miss a mortgage payment. That level of financial fragility is a massive red flag for a lender. To them, a high DTI screams risk. So, to compensate for the risk of you being financially overextended, they will once again charge you a higher interest rate, if they even approve the loan at all. Finally, there's the loan itself. The type of product you choose has its own built-in risk profile. Think about a 30-year fixed-rate mortgage versus a 15-year fixed-rate mortgage. From your perspective, the 30-year loan has a lower monthly payment, which seems less risky. But from the lender's perspective, it's the opposite. 30 years is an eternity in the financial world. Inflation could spike, the economy could crash and recover twice over. They are locking in an interest rate with you for 3 decades, promising not to change it no matter what happens. That's a huge risk for them. A 15-year loan, on the other hand, is much safer for the lender. They get their principal back twice as fast, cutting their long-term risk in half. Because it's less risky for them, they reward you with a significantly lower interest rate. This is also why adjustable-rate mortgages, or ARMs, often have such tantalizingly low introductory rates. With an ARM, you're agreeing to share the long-term risk with the lender. You get a lower rate for the first few years, but you accept the risk that the rate could go up later. The lender is protected from future rate hikes, and for taking on that risk yourself, they give you a discount up front. So, when you and your friend get quoted different rates, it's because you're playing with different hands. Your friend might have a 790 credit score, a 25% down payment, a DTI of 30%, and is opting for a 15-year loan. You might have a 710 credit score, a 10% down payment, a DTI of 42%, and want a 30-year loan. To the lender, you are two completely different universes of risk. And that 0.5% difference in your rates is the precise, calculated price of that risk. It's not personal, it's just math. But here's the thing. Your credit score, your down payment, your DTI, these are all about you. They create your personal risk profile. But there is one more massive piece to this puzzle. The lender themselves. Why can you take your exact same financial profile, the same score, the same income, the same down payment, to 2 different lenders and get 2 completely different offers? That's where the game within the game is played. That's where you can save or lose tens of thousands of dollars. And that secret world of mortgage shopping is exactly what we're breaking down next. So you walk into 2 doors. Behind door number 1 is a bank, a big familiar name you see on every street corner. Behind door number 2 is a mortgage broker, a name you've probably never heard of. One of these doors is statistically more likely to save you over $11,000 on your mortgage. Which one do you choose? The answer isn't as simple as you think, and it reveals the first secret of the mortgage shopping game. Let's start with the bank, or what we call a direct lender. This includes big national banks, your local credit union, and even those flashy online lenders. Think of them as the brand name store. You're going directly to the source. They have one set of products, their own, and they know them inside and out. The process can feel simpler, more streamlined. If you already bank with them, they might even offer you a small discount for your loyalty. The problem? You're only shopping at one store. They'll tell you they have the best deal, but they have absolutely no incentive to tell you if the store across the street has an even better one. You're living in their world, playing by their rules and seeing only their prices. Now let's look behind door number 2, the mortgage broker. A broker isn't a lender. They don't have a giant vault of money to lend you. Instead, they're a professional matchmaker. They're like a travel agent for loans. You tell them your destination, home ownership, and your budget, and they search through dozens of different wholesale lenders to find the best flight for you. They have access to a massive hidden marketplace of loan options that you would never find on your own. They can pit lenders against each other to get you a better rate, and they often work with specialty lenders who can handle tricky situations, like if you're self-employed or have less than perfect credit. So the broker is always better, right? Not so fast. The broker works for you, but they're paid by the lender through a commission, which is baked into your loan. And while they have access to more options, it doesn't automatically guarantee the lowest cost. Sometimes a big direct lender, because of their sheer size and scale, can offer a deal that no one else can touch. The truth is, neither door is universally better. The only winning move is to knock on both. You need to create a competition. The Consumer Financial Protection Bureau found that nearly half of all borrowers don't shop around for a mortgage. Half. That's like walking into the first car dealership you see, and just paying the sticker price without even looking at another lot. It's financial madness. Getting just one extra quote saves the average borrower $1,500. Getting 5 quotes can save you over $3,000. And we're not just talking about a one-time savings. This is money saved every single month for up to 30 years. Okay, so you're ready to create a competition. You're going to talk to a big bank, a local credit union, and a mortgage broker. What happens next? They're all going to start throwing numbers and terms at you that sound like a foreign language. And the most confusing of all is the concept of points. This is where lenders can hide the true cost of a loan, and where most beginners get completely lost. Let's demystify it. There are 2 kinds of points: origination points and discount points. Origination points are simple. It's a fee the lender charges for creating the loan. 1 point is equal to 1% of the loan amount. So on a $400,000 loan, 1 origination point is a $4,000 fee. It's just part of their cost of doing business, like a service charge. Discount points are where the real strategy comes in. Think of discount points as prepaying your interest. You pay a lump sum of cash up front, at closing, in exchange for a lower interest rate for the entire life of the loan. For example, a lender might offer you a 6.5% interest rate with 0 points. Or they might say, pay us 1 discount point $4,000 on that $400,000 loan, and we'll give you a 6.25% interest rate instead. Is that a good deal? Well, you have to do the math. You're paying $4,000 today to save a little bit of money every month. You need to figure out your break-even point. How many months will it take for your monthly savings to add up to the $4,000 you paid up front? If the lower rate saves you, say, $70 a month, you divide $4,000 by $70. That's about 57 months, or just under 5 years. If you plan on staying in that house for more than 5 years, paying the point is a fantastic deal. You're essentially locking in a discount for decades. But if you think you might sell or refinance in 3 years, you would have wasted that money. You'd have paid for a discount you never got to fully use. Lenders know this is confusing, so they might present you with 2 options, and one looks way better because the interest rate is so low. But they don't scream from the rooftops that it comes with $10,000 in points. This is why you cannot, under any circumstances, compare loans based on interest rate alone. So how do you compare them? You use the government-mandated cheat sheet, the loan estimate. After you formally apply for a loan, the lender is required by law to send you this standardized, 3-page document within 3 business days. This document is your best friend. It was specifically designed after the 2008 financial crisis to be a nutrition label for mortgages, forcing lenders to lay out all their costs in the exact same format, so you can easily compare them side by side. When you get your loan estimates from your different lenders, ignore the fancy marketing packets they come in and turn straight to page 1. There are 3 boxes you need to focus on. First is the interest rate. We know what that is. But right below it is the second, more important number. The APR, or annual percentage rate. What's the difference? The interest rate is just the cost of borrowing the money. The APR is the true cost of the loan. It takes the interest rate and adds in all the lender fees, the points, and some of the closing costs. Because the APR includes all those extra costs, it's almost always higher than the interest rate. It gives you a much more holistic, apples-to-apples view of which loan is actually cheaper over its lifetime. If lender A offers a 6.5% interest rate and lender B offers a 6.4%, you might think lender B is the winner. But if lender A's APR is 6.6% and lender B's is 6.8%, it means lender B is packing their loan with a ton of extra fees. Lender A is the better deal. The APR is your secret weapon for comparison. The third number to check is on page 2, under Calculating Cash to Close. This tells you exactly how much money you need to bring to the closing table. This is the bottom line. It includes your down payment, plus all the closing costs and prepaid items. Seeing this number in black and white can be a shock, but it's critical. It prevents any nasty surprises on closing day. So here's the playbook. Step 1. Get pre-approved by at least 3 different types of lenders: a big bank, a credit union, and a broker. Step 2. Once you have a house under contract, send the address to your top 3 contenders and ask for an official loan estimate. Step 3. Line up those loan estimates side by side. Compare the APR. Compare the lender fees. Compare the cash to close. Find the best offer. Let's say it's from the mortgage broker. Now, for the final move most people are too scared to make. You take that loan estimate from the broker, you email it to the big bank, and you say, "Can you match or beat this?" This is not rude. This is not aggressive. This is business. Lenders are competing for hundreds of thousands of dollars of your interest payments. They expect to compete, and they have room to negotiate. They might waive a fee or offer you a credit or magically find a lower rate. You have the leverage. By doing this one simple step, you can save thousands of dollars with a single email. So now you know how to make lenders compete for your business. You've got the playbook to shop not just for a rate, but for the entire loan, ensuring you get the absolute best deal possible from the marketplace. But what are they actually competing to sell you? A 30-year fixed? An adjustable rate mortgage, an ARM? An FHA loan? Choosing the right product is just as critical as choosing the right lender. And one of these common loan types is often called a trap for first-time buyers. We'll reveal which one and why in the next part. So let's talk about the trap. It's a loan product that looks incredibly attractive on the surface, especially when interest rates feel high. It dangles a lower monthly payment in front of you, a number that makes your dream home suddenly seem affordable. But this loan has a hidden switch. And when that switch flips, your comfortable payment can explode, sometimes overnight, leaving you financially scrambling. This loan is the adjustable rate mortgage, or ARM. Now, before anyone who has an ARM jumps into the comments, let me be clear. ARMs are not inherently evil. They are a financial tool, and like any powerful tool, they can be used brilliantly, or they can cause a lot of damage if you don't understand exactly how they work. For a first-time homebuyer, the risk of misunderstanding is huge. Here's the anatomy of the trap. An ARM is typically advertised with 2 numbers, like a 5-to-1, a 7/1, or a 10-to-1. The first number is the siren song. It's the number of years your interest rate is locked in at a low introductory teaser rate. For 5, 7, or 10 years, your mortgage payment is predictable and often significantly lower than it would be with a traditional fixed-rate mortgage. This is where the dream begins. You buy the house, you move in, you start your life. The payment is easy. You think you've beaten the system. But then the second number kicks in. The 1 in a 5-to-1 or 7-to-1 ARM means that after the initial fixed period is over, your interest rate will start to adjust once every year. And here's the critical part. It doesn't adjust based on your feelings or your budget. It adjusts based on a specific financial index, plus a margin set by the lender. Think of it like your rate is now tied to a roller coaster in the economy. When the roller coaster goes up, your rate goes up, and your payment goes up with it. Let's imagine a couple, Mark and Sarah. They buy their first home for $400,000. The The 30-year fixed rate is 7%, which feels daunting. Their payment would be about $2,660 a month just for principal and interest. But the lender shows them a 5-to-1 ARM with a teaser rate of just 5%. Suddenly, the payment drops to around $2,147. That's over $500 a month in savings. That's a car payment. That's their entire grocery budget. Feels like a no-brainer. They sign the papers and for 5 years everything is perfect. Then, in month 58, they get a letter from their mortgage company. It's a notice of their first upcoming rate adjustment. The underlying economic index has gone up significantly since they bought the house. Their new rate isn't going to be 5% anymore. It's adjusting to 8%. Their new monthly payment is now $2,935. That's not just $500 more than they were paying. It's nearly $800 more. Their budget is shattered. The breathing room they had is gone. Now they're facing tough choices. Do they stop saving for retirement? Do they cancel the family vacation? This is the arm trap springing shut. Now there are protections called caps. An ARM has caps on how much the rate can increase on the first adjustment, on subsequent adjustments, and over the lifetime of the loan. But even with these caps, a payment can easily increase by hundreds, or even over $1,000, creating a payment shock that many families simply aren't prepared for. The plan for many ARM holders is to just refinance before the adjustment hits. But what if, like in Mark and Sarah's case, rates have gone up across the board? Or what if your financial situation has changed? Maybe you lost a job or your credit score dropped. You might be trapped with that new, higher payment. So, when does an ARM make sense? It can be a strategic choice for a very specific type of buyer. If you know with near certainty that you will be selling the house and moving before the fixed rate period ends, you can use an ARM to save a significant amount of money. For example, a medical resident who knows they'll be moving for a new job in 4 years could use a 5-to-1 ARM to enjoy lower payments. It can also work for a high-income earner who can easily absorb the worst-case scenario payment increase and is simply using the ARM to optimize their cash flow. But for the average first-time buyer who sees this as their forever home, the risk often outweighs the reward. This brings us to the bedrock of American homeownership, the fixed-rate mortgage. Its beauty is its simplicity. Whether you choose a 30-year or a 15-year term, the interest rate you lock in on day one is the interest rate you will have for the entire life of the loan. Period. Your principal and interest payment will never, ever change. It is the definition of stability. A global pandemic could hit, the stock market could crash, inflation could soar. It doesn't matter. Your payment remains the same. This predictability is priceless for budgeting and long-term financial planning. The 30-year fixed is the most popular mortgage in the country for a reason. It spreads the cost of the loan over 3 decades, resulting in the lowest possible monthly payment for a fixed-rate product. This makes homeownership accessible to the widest range of people. But then there's its more aggressive sibling, the 15-year fixed-rate mortgage. The monthly payment on a 15-year is significantly higher because you're paying off the same amount of money in half the time. But the trade-off is staggering. First, lenders will almost always give you a lower interest rate for a 15-year term because their risk is lower. Second, and this is the mind-blowing part, you save an astronomical amount of money in interest. Let's go back to that $400,000 loan. On a 30-year fixed at 7%, you would pay a total of about $558,000 in interest alone over the life of the loan. Your house doesn't cost $400,000. It costs almost $1 million. Now, let's look at a 15-year fixed, maybe at a slightly better rate of 6.5%. Your monthly payment is higher, yes, but the total interest you pay is only about $223,000. By choosing the 15-year mortgage, you would save over $335,000. That's enough to buy a second property outright in some parts of the country. You build equity at lightning speed and you own your home free and clear 15 years sooner. So we have the risky ARM and the stable fixed rate. But there's a third category of loans we need to talk about because they break all the normal rules. These are government-backed loans. They were created to help specific groups of people achieve the dream of homeownership. The most common is the FHA loan, backed by the Federal Housing Administration. This is the go-to option for buyers who might not have perfect credit or a large down payment. You can get an FHA loan with a credit score as low as 580 and a down payment of just 3.5%. This opens the door for millions of people who would be turned away by conventional lenders. But there's a catch, and it's a big one: mortgage insurance premium, or MIP. Because the lender is taking on more risk, you have to pay an insurance premium. Unlike conventional loans where private mortgage insurance, PMI, eventually falls off, with most FHA loans, you are stuck paying that extra MIP fee every single month for the entire life of the loan, unless you refinance. Next are VA loans for veterans, active duty service members, and eligible surviving spouses. If you have served our country, this is one of the most powerful financial benefits you have earned. In most cases, you can buy a home with zero down payment, and you do not have to pay monthly mortgage insurance. This is a game changer, saving thousands up front and hundreds every month. Finally, there are USDA loans, backed by the Department of Agriculture. These are for buyers in eligible rural and some suburban areas. Like VA loans, they offer a zero down payment option. They're designed to promote homeownership outside of major urban centers, and they come with income limitations, but for the right buyer in the right location, they can be an incredible opportunity. So you have the loan products: adjustable, fixed, and government-backed. You've analyzed your risk tolerance, your timeline, and your financial situation. You've picked the perfect product for you. You get pre-approved, you hunt for houses, and you find the one. You make an offer, it's accepted. You're on top of the world. But then, a few days before you're supposed to get the keys, your lender sends you a 5-page document called a closing disclosure. And as you scan the columns of numbers, your heart sinks. You see thousands, maybe even $10,000 or $15,000 in fees you never knew existed. Lender fees, titla fees, escrow fees, appraisal fees. This is the final boss of buying a home: closing costs. And in the next part, we are going to break down every single one line by line so you know what's negotiable, what's a ripoff, and how to walk into your closing with confidence, never ever overpaying. Alright, let's pull back the curtain on this final, intimidating document. It's called the closing disclosure, and when you first see it, it looks less like a summary and more like a ransom note. It's a 3 to 5 page document filled with dozens of line items, acronyms, and numbers that all seem designed to confuse you. But here's the secret. All those fees, all those closing costs, aren't just a random jumble. They fall into 3 very distinct buckets. And once you understand these 3 buckets, you can instantly see where the power lies, what's negotiable, and what's set in stone. The 3 buckets are lender fees, third-party fees, and prepaids. That's it. Let's tackle the first and most important bucket, the lender fees. This is the money you are paying directly to the company giving you the loan. Think of this as their profit center. This bucket is your prime negotiating territory. The biggest line item you'll see here is that origination fee. This is the lender's charge for creating the loan. It can be a flat fee or, more commonly, a percentage of the loan amount, usually between 0.5% to 1%. So on a $400,000 loan, that could be $2,000 to $4,000 right there. Some lenders will advertise no origination fee, but that's often a marketing trick. They'll just bake that cost into other fees or give you a slightly higher interest rate. There's no free lunch. Right alongside the origination fee, you might see discount points. We've touched on these before, but it's critical to understand them here. 1 point costs 1% of your loan amount, and it buys you a lower interest rate for the life of the loan. This is a choice. You are choosing to pay more upfront to save money every month. This is 100% negotiable because you can choose to pay for 0 points, 1 point, or even fractions of a point. Now this is where it gets sneaky. Below those 2 big items, you might see a whole list of smaller fees. Things like an underwriting fee, a processing fee, an application fee, a document preparation fee. Lenders have 1,000 creative names for these. Let's call them what they are: junk fees. These are all just different ways of charging you for the administrative work of creating the loan. It's like going to a restaurant and getting a bill with separate charges for chef's salary, dishwasher usage, and table rental. It's ridiculous. A good lender will bundle all of this into a single, transparent origination fee. If you see a long list of these little administrative fees, you need to pick up the phone and ask your loan officer, "Can you explain every single one of these? Why are you charging me a processing fee and an underwriting fee? Isn't that all part of originating the loan?" Pushing back on these can often save you hundreds, if not $1,000, because often they're just hoping you won't notice. This bucket, the lender fees, is where you have the most direct control. Okay, on to bucket number 2, third-party fees. These are fees for services provided by companies other than your lender. Your lender is required to arrange these services, but they don't pocket the money directly. This is why these fees are less negotiable, and this is a big but, you can still save a ton of money here by being smart. The first one you'll see is the appraisal fee. This is what you pay a licensed appraiser to determine the official value of the home. The lender requires this to make sure they aren't lending you $400,000 for a house that's only worth $300,000. You can't really negotiate the cost of the appraisal itself, but you can choose a lender who works with more reasonably priced appraisal management companies. Next is the credit report fee. This is usually small, maybe $30 to $50 to pull your credit history. Not much you can do here. But now we get to a monster: title services and lender's title insurance. This can easily be one of your biggest closing costs, often running well over $1,000. So what is it? Title insurance protects the lender in case there are any hidden issues with the property's ownership history. A forgotten heir, a forged signature from 50 years ago, an unpaid contractor's lien. The title company does a deep dive search into the property's records to make sure the seller has the legal right to sell it to you. And then they issue an insurance policy. Now, the lender's title insurance is mandatory, but you will also be offered an owner's title insurance policy. This one protects you. My advice? Always get the owner's policy. It's a one-time fee that protects you for as long as you own the home. It's peace of mind you absolutely want to have. Here's the pro tip. In many states, you have the right to shop for your own title company. Your lender will recommend one, but their recommendation might not be the cheapest. A few phone calls to other local title companies could literally save you $500 to $1,000 on this single line item. You might also see fees for a land survey, to identify the property lines, or a flood certification fee, to determine if the property is in a flood zone. These are all third-party services. You can't avoid them if they're required, but you can always ask if you're allowed to shop for a different provider. So that's bucket 2. You have less direct negotiation power, but you have the power of choice, and that can lead to massive savings. Finally, we arrive at bucket number 3, prepaids and escrow. This is the single most misunderstood part of closing costs. And here's the key. This is not a fee. This is your money. You are not paying it to someone. You are simply putting your own money into a savings account to cover future expenses. Let's break it down. The first item is prepaid interest. Your first mortgage payment isn't due until the first day of the month after the month you close. So if you close on June 15th, your first payment isn't until August 1st. But the bank loaned you the money on June 15th. So at closing, you have to pay the interest for the remaining days of June, from the 15th to the 30th. It's just paying for the days you've actually had the loan. Fun tip. If you want to lower this specific cost, try to close at the very end of the month. Next, you'll have to prepay for your first full year of homeowner's insurance. The lender requires this to protect their investment. But you get to choose the insurance company. Do not just go with the first quote you get. Shop around with at least 3 to 5 different insurance providers. The difference between the cheapest and most expensive policy for the exact same coverage can be staggering. We're talking hundreds of dollars a year every single year. And the last big one is your initial escrow deposit. This is where you pre-fund your escrow account. Remember, this is the account your lender uses to pay your future property taxes and homeowner's insurance on your behalf. At closing, they need to collect a cushion. Usually, they'll collect a few months of property taxes and a few months of homeowner's insurance premiums up front to make sure there's always enough in the account to pay those bills when they come due. Again, this is your money. If you ever sell the house or refinance, you get whatever is left in that escrow account back. So how do you make sure you're not getting ripped off? You use your secret weapon. 3 days before your closing, by law, your lender must give you that official closing disclosure. Your job is to take that document and compare it line by line to the loan estimate they gave you when you first applied for the loan. The fees in bucket 1, the lender fees, cannot change at all. It's a zero-tolerance category. If your origination fee was $2,000 on the estimate, it has to be $2,000 on the final disclosure. If it's higher, you call them out. Many of the fees in bucket 2 have a 10% tolerance, meaning they can't increase by more than 10% combined. And the costs in bucket 3 can change because they are based on the exact day you close and the insurance provider you choose. By understanding these 3 buckets, you transform from a confused buyer into an empowered auditor. You know what to question, what to shop for, and what's just your own money being set aside for later. You are now in control. You've navigated the rate locks, you've deciphered the closing costs, and you've walked out of the closing with the keys in your hand, confident you got a great deal. But as you make that first mortgage payment and the second and the third, you might notice a pesky, annoying line item that just won't go away. A fee that feels like you're setting a $100 bill on fire every single month for absolutely no benefit to you. It's called PMI, or private mortgage insurance, and in the next part we're going to show you exactly what it is, why you're forced to pay it, and most importantly, the secret strategies you can use to get rid of it years ahead of schedule. It's an insurance policy, but it's not for you. Think about that for a second. You pay the bill every single month, but if something goes wrong, you don't see a dime. The insurance payout goes directly to the bank that gave you the loan. It sounds completely backwards, right? Well, that's PMI. It's the lender's insurance policy against you, the borrower. Specifically, it's insurance in case you default on your loan and the bank has to foreclose. They see you as a higher risk and they're forcing you to pay for their own protection. So why are you considered a higher risk? It all comes down to one magic number: 20%. For decades, the gold standard in the mortgage world has been putting 20% of the home's purchase price down in cash. If you buy a $400,000 house, that's an $80,000 down payment. If you can do that, the lender sees you as having significant skin in the game. You have a lot to lose, so you're much less likely to just walk away from your payments. In their eyes, you're a safe bet. No PMI for you. But let's be realistic. In today's market, saving up an extra $80,000 is a monumental task for most people. The reality is, millions of Americans buy homes with far less down: 10%, 5%, even as little as 3%. And that's where the banks get nervous. When you have less equity tied up in the home, you represent a bigger gamble for them. So, to approve your loan, they lay down a condition: you have to pay for their insurance. You have to pay PMI. What does this actually cost? It's not a small chunk of change. PMI typically costs between 0.5% and 1% of your entire loan amount per year. Let's put that into real dollars. Say you buy a $300,000 house and put 5% down, which is $15,000. Your loan amount is $285,000. At a 1% PMI rate, you're paying an extra $2,850 a year. That's an extra $237 tacked onto your mortgage payment every single month. That's a car payment. That's your grocery bill for a week. And the worst part? It does absolutely nothing to pay down your loan or build your equity. It's like setting $250 on fire in your driveway every month. Over 5 years, that's over $14,000 vanished into thin air. This is the PMI trap. It feels like a penalty for not being wealthy enough to make a huge down payment. But here's the good news I promised. This is not a life sentence. You are not stuck paying this forever. There are clear, actionable strategies to get rid of PMI, and most people just wait for it to happen automatically, which is the slowest and most expensive way to do it. We're going to do it the smart way. There are essentially two timelines for killing PMI: the lender's timeline and your timeline. The lender's timeline is dictated by law. The Homeowners Protection Act says that your loan servicer must automatically terminate your PMI on the date when your loan balance is scheduled to reach 78% of the original value of your home. So if you bought your house for $400,000, your PMI must automatically disappear when you've paid the loan down to $312,000. This is the slow road. This is you just making your regular payments month after month, year after year, until you finally hit that magic number. It could take 7, 8, even 10 years depending on your interest rate. But your timeline can be much, much faster. The law also gives you the right to request, to demand, that your PMI be canceled earlier. You can make this request once your loan balance reaches 80% of the home's original value. That's a 2% difference from the automatic cutoff. But requesting it yourself can shave months or even a year off your PMI payments. All you have to do is write a letter to your lender once you hit that 80% mark. It's the first and simplest step to taking control. But this is where the real secrets come in. Both of those methods are based on the original value of your home. What if your home is worth more now than when you bought it? This is the key that unlocks the fast track to eliminating PMI. If your local real estate market has been hot and property values have gone up, you might already have the equity you need and you don't even know it. Let's run through a powerful example. Imagine you bought a house 2 years ago for $400,000. You put 5% down, or $20,000, so your loan was for $380,000. Now, 2 years later, you've been making your payments and you've paid your loan down to, let's say, $370,000. Based on the original purchase price, your loan is still way above the 80% threshold. You'd have years of PMI payments left. But because you live in a desirable area, your home's value has skyrocketed. A new official appraisal shows your house is now worth $500,000. Now let's do the math again. Your loan is $370,000. Your home's value is $500,000. Your loan-to-value ratio is now 74%. You've blown past the 80% mark needed to request cancellation. You are now in the clear. So how do you make this happen? Step 1 is to do some recon. Go on Zillow, on Redfin, look at what similar homes in your neighborhood have sold for recently. If it looks like your home value has gone up significantly, it's time for step 2. Contact your lender. Tell them you believe you have sufficient equity based on current market value, and you'd like to request PMI removal. They will require you to pay for a new formal appraisal, which usually costs between $400 and $600. But paying $500 one time to save over $200 every single month is one of the best investments you will ever make. If that appraisal comes in high enough, your lender is obligated to drop the PMI. We're talking about a strategy that can save you tens of thousands of dollars and cut years off your PMI sentence. There's another way to accelerate this, by attacking the loan principal directly. Every extra dollar you pay towards your mortgage principal is a dollar that chips away at that loan balance and pushes you closer to the 80% equity goal. This could mean making one extra mortgage payment a year, or even just rounding up your payment every month. If your payment is $1,425, pay $1,500. That extra $75 goes straight to the principal, and while it might not feel like much, it acts like a snowball rolling downhill, speeding up your journey out of PMI. Now, a critical warning. This advice applies to conventional loans. If you have an FHA loan, you're in a different ballpark with a different set of rules. FHA loans have something called a mortgage insurance premium, or MIP. For most FHA loans originated after 2013 where you put down less than 10%, the MIP is mandatory for the entire life of the loan. It never goes away automatically. It doesn't matter if your house triples in value. You're stuck with it. The only way to get rid of FHA mortgage insurance is to get rid of the FHA loan itself. And that brings us to the ultimate weapon in the fight against PMI and high interest rates: refinancing. Refinancing is when you replace your current mortgage with a brand new one. If your home value has increased, or you've paid down a good chunk of your loan, you can refinance into a new conventional loan that has no PMI attached at all. For those with an FHA loan, this is their only escape route. For those with a conventional loan, it can be a way to not only ditch PMI, but also to lock in a much lower interest rate at the same time, saving you money in two different ways. But refinancing is a complex strategic decision. Doing it at the wrong time or for the wrong reasons can actually cost you thousands. You need a battle plan. And in the next part, we're going to give you that plan. We'll break down exactly when you should consider refinancing, how to shop for the best deal, and the hidden fees and traps you absolutely must avoid. So the mission is clear. You need a battle plan for refinancing. This isn't just about filling out some paperwork. It's a strategic financial strike that can either save you a fortune or cost you dearly. Get it right and you could free up hundreds of dollars a month, pay off your house a decade early, or fund a life-changing project. Get it wrong and you could end up paying more in the long run than if you'd done nothing at all. First, let's talk timing. When is the right moment to pull the trigger on a refinance? There are 4 main scenarios for green lights you should be watching for. The most obvious one is a significant drop in interest rates. For years, the rule of thumb was the 1% rule. If you could get a new rate that was at least 1% lower than your current one, it was worth looking into. So if you had a rate at 6.5%, and the market was offering 5.5%, ding ding ding, it's time to make some calls. A 1% drop on a $400,000 loan could save you over $200 every single month. Over the life of the loan, that's tens of thousands of dollars back in your pocket. But here's the modern twist. With today's razor-thin margins and fluctuating closing costs, even a 0.5% drop can sometimes be enough to justify a refinance, especially on larger loan balances. The key isn't a magic number. It's about running the actual calculation, which we'll get to in a minute. The second green light is when you want to change the terms of your loan. This is a power move. Let's say you're 5 years into a 30-year mortgage, but you've gotten a promotion, your income is higher, and you're feeling financially strong. You can refinance from that 30-year loan into a 15-year loan. Yes, your monthly payment will go up, often significantly, but the trade-off is staggering. You'll typically get an even lower interest rate than a 30-year offers, and you'll be building equity at lightning speed. You're essentially putting your mortgage on hyperdrive, aiming to own your home free and clear in half the time. The amount of interest you save is astronomical. Of course, the opposite is also true. Maybe life threw you a curveball, a job change, new family expenses, or you just want to free up cash flow for other investments. You can refinance a 15-year mortgage back into a 30-year. This will almost always mean paying more in total interest over time, but it can dramatically lower your monthly payment, giving you crucial breathing room in your budget. It's a safety valve. The third and perhaps most tempting reason to refinance is to tap into your home's equity. This is called a cash-out refinance. Imagine your house is a piggy bank. Over the years, as you've made payments and as the property value has increased, that piggy bank has gotten fuller and fuller. A cash-out refi lets you crack it open. You take out a new, larger mortgage than what you currently owe, and the lender gives you the difference in cash. People use this money for everything: major home renovations, paying for college, starting a business, or consolidating high-interest debt. Can be an incredibly powerful tool. You're turning your illiquid home equity into cold, hard cash, often at a much lower interest rate than a personal loan or credit card. But this comes with a serious warning. You are increasing your mortgage debt. You are turning unsecured debt, like a credit card bill, into secured debt. If you fail to pay your credit card, it ruins your credit. If you fail to pay your mortgage, you lose your home. It raises the stakes, so you must have a disciplined plan for that cash. And the fourth green light? Getting rid of private mortgage insurance, or PMI. If you bought your home with less than 20% down, you're likely paying this extra fee every month. But if your home's value has shot up, you might now have more than 20% equity. A refinance can serve as a new appraisal, officially recognizing that new value, and if you cross the 20% equity threshold, you can get a new loan without that pesky PMI payment, saving you $100, maybe $200 every single month. Okay, so you've seen a green light. How do you actually shop for the best deal? This is where the real work begins. Step 1: check your own vitals. Before you talk to a single lender, you need a financial self-portrait. Pull your credit report and check your score. Is it higher than when you first bought the house? It should be. Lenders reserve the best refinance rates for people with excellent credit. Also, calculate your debt-to-income ratio. Has it improved? You need to present yourself as a lower-risk borrower now than you were before. Step 2. Assemble your team of lenders. Do not, I repeat, do not just go back to your current lender. That's like accepting the first offer on your house without seeing what other buyers are willing to pay. You need to create a competitive environment. Get quotes from at least 4 different sources. First, your current lender. They might offer a streamlined process to keep your business. Second, a major national bank. Third, a local credit union. They often have great rates and lower fees for their members. And fourth, and this is the pro tip, a mortgage broker. A broker doesn't work for one bank. They work for you. They have access to dozens of wholesale lenders and can shop for the best deal on your behalf, finding options you'd never find on your own. Step 3. Compare apples to apples using the loan estimate. Once you apply, each lender is legally required to give you a standardized, 3-page document called a loan estimate within 3 days. This is your secret weapon. It breaks down the loan in exactly the same way from every lender. Don't just look at the interest rate on page 1. Look at the APR, the annual percentage rate. The APR includes not just the interest, but also most of the fees, giving you a more accurate picture of the loan's true cost. Then go to page 2, section A, origination charges. This is the lender's pure profit. This is the number you can often negotiate. Which brings us to step 4, negotiate. Take the best loan estimate you've received and play the lenders off each other. Call lender B and say, "Listen, I'd love to work with you, but lender A is offering the same rate with $500 less in origination fees. Can you match or beat that?" You are the customer, you have the power. A simple phone call could save you $1,000. Now for the most important part of the battle plan. The traps and hidden fees you must avoid. The biggest one is ignoring closing costs. Refinancing isn't free. You'll pay for things like an appraisal to confirm your home's value, title insurance, and those lender origination fees. These costs typically run between 2 to 5% of the total loan amount. On a $400,000 loan, that could be anywhere from $8,000 to $20,000. This is why you must calculate your break-even point. This is the single most important piece of math in the entire process. It's simple. Take your total closing costs and divide them by your monthly savings. So if your closing costs are $6,000 and your new loan saves you $200 a month, your break-even point is 30 months. It will take you 2.5 years of living in that house just to pay back the cost of the refinance. If you think you might move or sell before then, refinancing is a financial mistake. You will lose money. Beware the siren song of the no-cost refinance. There is no such thing. It's a marketing gimmick. Lenders who offer this are simply hiding the costs in one of two places. They either roll the closing costs into your total loan balance, meaning you're paying interest on them for the next 30 years, or they give you a higher interest rate. The cost is always there, it's just camouflaged. And finally, the most subtle but devastating trap: resetting the amortization clock. Let's say you've been diligently paying your 30-year mortgage for 7 years. You've paid a ton of interest, but you're finally starting to make a real dent in the principal. Then you refinance into a brand new 30-year loan. You just took those 7 years of progress and threw them away. Your payment is lower, sure, but your loan term is now effectively 37 years. Even with a lower interest rate, you could end up paying tens of thousands more in total interest over the life of the loan because you extended the timeline for so long. If you do refinance, always try to get a shorter term, or at the very least, make extra payments to stay on your original payoff schedule. You now have the refinancing playbook. You know when to strike, how to shop, and what traps to avoid. But all of this strategy happens within a much bigger arena. The interest rate you're offered isn't just about you. It's about the entire US economy. It's about a group of people in Washington, D.C. making decisions that echo in your wallet. In the next part, we're pulling back the curtain on the Federal Reserve and revealing the invisible forces that dictate the cost of your mortgage. So, who are these people? They're not some shadowy cabal meeting in a smoke-filled room. They are the governors of the Federal Reserve, America's central bank, often just called the Federal, and their decisions, made in a rather formal boardroom in Washington, D.C., create the economic weather that every single homebuyer has to navigate. To understand mortgage rates, you have to understand the Federal. Think of the Fed as the nation's economic thermostat, with two very specific and often conflicting instructions. Their first instruction is to keep prices stable. This is their fight against inflation. When the price of everything from gasoline to groceries starts climbing too fast, it erodes the value of your dollar. The Fed's job is to cool things down. Their second instruction is to strive for maximum employment. This means creating an environment where anyone who wants a job can find one. They want the economy humming along, with businesses hiring and expanding. Now, here's the multi-trillion-dollar problem. These two goals are often in direct opposition. The actions you take to cool down inflation, like making it more expensive to borrow money, can slow down the economy and lead to job losses. And the actions you take to boost employment, like making money cheap and easy to borrow, can cause the economy to overheat and trigger inflation. It's a perpetual tightrope walk. The Fed is constantly trying to find that perfect balance, that Goldilocks economy that's not too hot, not too cold, but just right. And the main tool they use to walk this tightrope, the primary lever they pull to adjust that economic thermostat, is something called the federal funds rate. Now, that sounds incredibly complex, but the concept is surprisingly simple. The federal funds rate is the interest rate that big banks charge each other for overnight loans. That's it. Imagine all the major banks are in a group chat. At the end of every day, some banks might have a little extra cash, while others might be a little short. So, in the group chat, they lend money back and forth to each other just to cover their books for the night. The federal funds rate is the interest rate they agree on for those tiny, overnight loans. But here's the genius of it. The Fed doesn't just let them pick any rate they want. The Fed sets a target for that rate. And by setting the cost of money for the biggest players in the game, the banks themselves, they create a ripple effect that touches every corner of the economy. Let's go back to our thermostat analogy. Imagine the economy is running too hot. Inflation is soaring. People are spending like crazy, and prices are getting out of control. The Fed sees this and says, "We need to cool things down." So they raise the federal funds rate. Suddenly, it becomes more expensive for Bank of America to borrow overnight from JP Morgan Chase. What does Bank of America do? They pass that increased cost on to their customers. The interest rate on your credit card goes up. The rate for a small business to get a loan to expand goes up. The rate for a car loan goes up. And yes, the cost for a lender to fund your mortgage goes up. By making it more expensive to borrow money, the Fed puts the brakes on spending. People think twice about buying that new car. Businesses postpone building that new factory. The entire economy takes a collective deep breath and slows down. The heat dissipates. Inflation starts to cool off. Now let's flip it. Imagine the economy is cold. A recession is looming, businesses are laying off workers, and people are scared to spend money. The Fed says, "We need to turn up the heat." They cut the federal funds rate. Now it's incredibly cheap for banks to borrow from each other. They have access to easy money and they want to lend it out. To compete for your business, they start lowering their own interest rates. Credit cards offer 0% introductory rates. Businesses can get cheap loans to hire people and buy new equipment. And mortgage rates start to fall, encouraging people to buy homes and stimulate the housing market. It's like an economic stimulus package designed to get money flowing and get the economy growing again. So problem solved, right? The Fed raises rates, mortgage rates go up. The Fed cuts rates, mortgage rates go down. Seems simple. But if you've been paying attention to the news, you know it's not a perfect one-to-one relationship. Sometimes the Fed will announce a rate hike, and mortgage rates will barely move. Other times the Fed will do nothing, and mortgage rates will shoot up. Why? Because the federal funds rate is a short-term, overnight rate. A mortgage, on the other hand, is a very long-term loan, often spanning 30 years. And for long-term loans, there's another, even more important indicator we need to watch. This is the part of the puzzle that most people miss. It's the 10-year Treasury yield. What on earth is that? Let's break it down. When the United States government needs to borrow money, it issues bonds. A bond is basically an IOU. You give the government money today, and they promise to pay you back in the future with interest. A 10-year Treasury bond is simply an IOU from the U.S. government that matures in 10 years. The yield is the effective interest rate you get on that bond. Now, why is this one specific government IOU so important? Because it's considered one of the safest investments on planet Earth. The U.S. government has never ever failed to pay back its debt. Because of this incredible safety, the 10-year Treasury yield has become the benchmark, the North Star, for all other long-term interest rates in the U.S., including mortgages. Think of it like this. An investor has money and they want to lend it out for a long period of time. They have two basic options. They can lend it to the U.S. government by buying a 10-year Treasury bond, which is virtually risk-free. Or they can lend it to a homebuyer through a mortgage-backed security, which has a little more risk. People can lose their jobs and default on their loans. The U.S. government, for all intents and purposes, cannot. So, for an investor to choose the slightly riskier mortgage, the interest rate on that mortgage has to be higher than the rate on the super-safe Treasury bond. It has to offer a risk premium to make it worthwhile. This is why mortgage rates and the 10-year Treasury yield tend to move in lockstep. They are like two dancers in a ballroom. When the Treasury yield takes a step up, the mortgage rate takes a step up. When the Treasury yield dips, the mortgage rate follows it down. They shadow each other day after day. So while the Fed is controlling the temperature in the ballroom with its short-term federal funds rate, the actual dance of long-term mortgage rates is led by the 10-year Treasury yield. The Fed's actions and, more importantly, its words, heavily influence the Treasury yield. If the Fed signals it's going to be aggressive in fighting inflation by raising rates, investors anticipate a slowing economy and start buying up safe Treasury bonds. When lots of people want to buy bonds, the price goes up and the yield goes down. Conversely, if the Fed signals the economy is strong and they're going to ease up, investors might sell their safe bonds to buy riskier stocks, causing bond prices to fall and yields, and therefore mortgage rates, to rise. It's a complex dance with many partners. The Federal Reserve sets the mood and the tempo of the music. But your mortgage rate isn't directly listening to the Federal. It's watching the bond market. It's watching a global network of traders, investors, and massive funds who are placing bets every single second on what they think the economy will do tomorrow, next year, and 10 years from now. And their collective opinion is reflected in that single powerful number, the 10-year Treasury yield. The Fed may be the architect, drawing up the blueprints for the economy, but the bond market is the construction crew reacting to those plans in real time and ultimately deciding the final price of the materials, including the cost of your mortgage. And in that chaotic, lightning-fast market, psychology is just as important as policy. So if the market is a construction crew, think of market psychology as the crew's group chat. The architect, the Fed, sends down the official blueprints. But in the group chat, the crew is gossiping. They're sharing news articles, rumors, and gut feelings. One guy heard a rumor that steel prices are about to skyrocket. Another saw a weather report about a hurricane that could shut down the lumber mills for weeks. Suddenly, before the architect even thinks about changing the plans, the crew starts hoarding materials and charging more for their time. They're reacting not to the official plan, but to their fear of what might happen tomorrow. That, in a nutshell, is how market sentiment can overpower Fed policy and send mortgage rates on a wild ride. This entire system, this massive global financial market, runs on two primal human emotions: fear and greed. When investors are greedy, or more politely optimistic, They believe the economy is strong and corporate profits will grow. They sell their safe, boring government bonds and pour that money into the stock market, chasing higher returns. Remember our seesaw? When everyone is selling bonds, the price of those bonds goes down and the yield, the interest rate, goes up. Since mortgage rates are benchmarked to these yields, they get pulled up too. Optimism about the economy often means higher mortgage rates. But then there's fear. Fear is a much more powerful and much faster motivator. When something terrible happens, a global pandemic, a major war, the collapse of a huge bank, investors panic. They don't care about high returns anymore. They just want their money to be safe. They want to survive. And what is the single safest financial asset on planet Earth? The U.S. Treasury bond. It's backed by the full faith and credit of the United States government, the largest economy in the world. So during a crisis, a tidal wave of money from all over the globe comes flooding into U.S. bonds. This is called a flight to safety. And what happens when everyone is desperately trying to buy the same thing? The price skyrockets. And when the price of a bond goes up, its yield plummets. Mortgage rates, tied at the hip to those yields, fall right alongside them. This is why, in the chaotic early days of 2020, as the world was shutting down, mortgage rates fell to historic, once-in-a-lifetime lows. It was the global flight to safety in action. This emotional roller coaster isn't just triggered by once-a-century pandemics. It happens on a smaller scale every single day, driven by the relentless 24/7 news cycle. A geopolitical conflict flares up in the Middle East. What does that have to do with your mortgage in Ohio? Well, traders worry the conflict could disrupt oil supply. Higher oil prices mean higher gas prices and shipping costs, which could lead to inflation. If inflation gets worse, the Fed might have to raise its key interest rate to cool things down. So, bond traders trying to get ahead of the Fed start selling bonds today in anticipation of what the Fed might do months from now. Bond yields tick up, and so does the rate on your 30-year fixed mortgage. All because of a conflict half a world away. Or let's say a report comes out showing that the Chinese economy is slowing down much faster than expected. Why should you care? Because a weaker Chinese economy means less global demand for goods, which could lead to lower inflation worldwide. It also creates global uncertainty. So what do international investors do? They pull their money out of riskier markets and park it in the safe haven of U.S. Treasury bonds. This flight to safety pushes bond prices up and yields down, potentially lowering your mortgage rate in the U.S., even if our own economy is doing just fine. It's a stark reminder that your mortgage rate isn't set in a vacuum. It's plugged into the entire global economic nervous system. Every piece of major economic data acts as a jolt to this system. The monthly jobs report is a huge one. If the report shows the U.S. added way more jobs than expected, the market sees that as a sign of a very strong, hot economy. That's good news for workers, but it's also a sign of potential future inflation. Bond traders react instantly, selling bonds and pushing rates higher, sometimes within minutes of the report's release at 8:30 a.m. Eastern Time. Conversely, if the jobs number is surprisingly weak, it signals a cooling economy. Traders buy bonds as a safe haven and rates dip. The same goes for the Consumer Price Index, or CPI, the main inflation report. A hot inflation number sends rates soaring. A cool number can bring them back down. But here's the most fascinating and often frustrating part. The market doesn't just react to the data itself. It reacts to the story or the narrative that the data tells. For a long time, the narrative might be that inflation is temporary. During this period, a high inflation report might come out, and the market just shrugs. Traders say, yeah, we knew it would be high, but it's a blip. The Fed isn't going to overreact, so we won't either. Rates barely move. Then one day the narrative shifts. Maybe a few influential Fed officials give hawkish speeches, or a respected economist publishes a scary article. Suddenly, the story changes to inflation is out of control, and the Fed is behind the curve. Now, when the exact same kind of high inflation report is released, the market panics. It's no longer seen as a blip. It's seen as proof of a disaster. The same data point that was ignored a month ago now causes a massive bond sell-off, sending mortgage rates through the roof. The numbers didn't change, but the market's interpretation of them, the story it was telling itself, did. So what does this whirlwind of psychology, global news, and shifting narratives mean for you, the person just trying to buy a home? It means that the interest rate you were quoted last Tuesday is ancient history. The rate can, and often does, change every single day. Sometimes it can change multiple times within a day. A lender might release their rates in the morning, But if a big economic report comes out at 8:30 or the Fed chair gives a speech at 10 o'clock that spooks the market, that lender might pull their rate sheet and reprice all their loans by lunchtime. This is why the concept of a rate lock is so critically important. When you lock your interest rate with a lender, you are essentially freezing it for a set period, usually 30, 45, or 60 days. You are making an agreement. The lender guarantees you that specific rate, as long as you close your loan within that window. You are now protected. If the market goes crazy and rates spike 0.5% the next day, it doesn't matter. Your rate is safe. You've insulated yourself from the chaos. Of course, the flip side is that if rates fall dramatically, you're stuck with your higher locked rate, unless your lender offers a float-down option, which often comes with a fee. Ultimately, a rate lock is an insurance policy against volatility. It's you taking a stand in the middle of a chaotic, emotionally driven marketplace and saying, "Okay, this is my number. I can live with this payment. I'm getting off the roller coaster now." Because trying to perfectly time the market, to lock in at the absolute bottom of a dip, is a fool's errand. Even the most brilliant traders on Wall Street get it wrong all the time. We've seen the Fed's grand architectural plan. We've seen the market's emotional, real-time reaction. And we've seen how global events can throw a wrench in the whole process. The system is complex, unpredictable, and driven as much by fear as by spreadsheets. But navigating it doesn't require a crystal ball. It requires a strategy. The goal isn't to predict the future, but to prepare for it. And that preparation involves making smart, informed decisions about the loan you choose, the time you lock, and the team you work with. It's about taking all this knowledge and turning it into power. And that is exactly how you win the game. So let's define what winning the game actually means. It doesn't mean you snag the absolute lowest interest rate in the history of modern finance. That's a lottery ticket, not a strategy. Winning means you secured a loan that fits your life, with a payment you can confidently afford, and a rate that was the best possible outcome for your specific financial picture at that specific moment in time. It means you walked away from the closing table without a shred of buyer's remorse, feeling empowered, not exhausted. So, how do we get you to that finish line? We create your personal mortgage playbook, a step-by-step plan you can follow starting today. Step 1: the financial pregame. This happens months, ideally a year, before you even talk to a lender. You are going to become the master of your own financial universe. First, pull your credit reports. All 3 of them. Go through them line by line like a detective. Dispute any errors, no matter how small. Then, focus on that FICO score. As you now know, it's the bedrock of your interest rate. Pay every single bill on time. Every single one. Set up autopay if you have to. Then, attack your credit card balances. Get them below 30% of your limit, and if you can, below 10%. This isn't just about paying down debt. It's about signaling to lenders that you are a low-risk, responsible borrower. At the same time, start stockpiling cash. You need a down payment, yes, but you also need closing costs and you need reserves. A lender wants to see that you won't be financially wiped out the day you get the keys. Having a few months of mortgage payments sitting in the bank after closing is a massive green flag. Step 2. Define the mission. What are you actually trying to accomplish? This isn't a trick question. Are you buying a starter home you plan to sell in 5 to 7 years? Or is this your forever home where you'll raise a family? The answer dramatically changes your loan choice. If you're moving in a few years, that 7-to-1 arm we talked about, with its lower initial rate, suddenly looks a lot more attractive than a 30-year fixed. Be brutally honest with yourself about your goals and your risk tolerance. Don't choose an arm if the thought of a future payment adjustment will keep you up at night, no matter how much sense it makes on paper. This is your life and your peace of mind. Step 3. Assemble your A-team. You are the CEO of your home purchase and you need to hire the best. This means finding 2 key players: a great real estate agent and an exceptional loan officer. Don't just go with the first person you find on Google. Ask for referrals from friends, family, and colleagues who recently bought a home. Interview at least 3 of each. For real estate agents, ask them about their experience in the specific neighborhoods you're targeting. For loan officers, ask them about their communication style. Ask them how they handle tricky situations. You want a loan officer who is a teacher and a strategist, not just a salesperson. This person will be your guide through the financial maze. So find someone you trust, someone who answers your questions patiently, and someone who is proactive. A great loan officer can be the difference between a smooth closing and a complete nightmare. Step 4. The comparison gauntlet. Once you have your team and you're ready to make an offer, It's time to shop for your mortgage. And I mean really shop. You must, I repeat, must apply with at least 3 to 5 different lenders. A bank, a credit union, and a mortgage broker is a great mix. Why? Because every lender has different overhead, different profit margins, and access to different loan programs. The difference in the interest rate they offer you for the exact same loan could be a quarter of a point, half a point, or even more. Over 30 years, that tiny difference can add up to tens of thousands of dollars. When you apply, do it all within a 14-day window. The credit bureaus know you're rate shopping, and all those mortgage inquiries will be treated as a single event, minimizing the impact on your credit score. Within 3 days of each application, you'll receive a standardized document called a loan estimate. This is your secret weapon. It's designed by the government to make comparing offers easy. You'll line them up side by side and compare the interest rate, the APR, the closing costs in Section A, and the total cash you need to close. This is where you separate the good deals from the bad. Step 5, the rate lock standoff. You've chosen your lender. You're under contract on a house. Now comes the daily dance with the market. Your loan officer should be your partner here, giving you updates on what the market is doing. Is the Fed meeting this week? Is a big inflation report coming out? These are the days you watch closely. Remember what we said. You can't time the market perfectly, but you can make an educated decision. The goal is to lock your rate on a dip. Work with your loan officer to set a target. Maybe you say, if the rate for my loan hits 6.5%, I want to lock immediately no matter what. This takes the emotion out of it. It turns a gut-wrenching guess into a calculated move. Once you lock, you're protected if rates go up. You can finally breathe a little easier and focus on getting to the closing table. And finally, step 6, life after closing. Getting the keys isn't the end of your mortgage journey. It's just the beginning. Your first mortgage is not a life sentence. Think of it this way, you date the house but you only marry the loan. And if you're in a bad marriage with a high interest rate, you can get a divorce. It's called refinancing. You need to keep an eye on interest rates even after you buy. If rates drop significantly, say a full percentage point or more below what you have, it might be time to run the numbers on a refinance. This could lower your monthly payment, shorten your loan term, or allow you to tap into your home's equity. Also, consider your payment strategy. If you can afford to, making one extra mortgage payment per year, or even just paying a little extra each month towards the principal, can shave years off your loan and save you an astonishing amount in interest. Look, I know this is a lot. This entire series has been a deep dive into a complex world. It can feel overwhelming, like you're trying to drink from a fire hose. But here's the truth. You don't need to be a Wall Street analyst to get a great mortgage. You just need to be an educated consumer. You need to be patient, diligent, and willing to ask questions. The process of buying a home will test you. There will be moments of frustration and anxiety. There will be paperwork that seems endless and hurdles that feel impossible. But every single person who has ever bought a home has walked that same path. The key is to control what you can control. You can control your credit score. You can control your savings. You can control who you choose for your team. You can control how many lenders you shop with. Focus on those things. By watching this series, you've already given yourself an advantage that 99% of homebuyers don't have. You understand the why behind the numbers. You know the questions to ask. You know how the pieces fit together. You are no longer just a passive applicant hoping for the best. You are an active participant, capable of steering your own ship. This knowledge is your armor. It protects you from bad advice, predatory lenders, and costly mistakes. It transforms fear and uncertainty into confidence and clarity. The journey to homeownership is a marathon, not a sprint. But you've just completed your training. You have the playbook. You're ready. Now go out there and win the game.